and then began a pretty sharp decline. Soon after the decline began, it seemed obvious, at least with hindsight, that the stock decline had momentum and was likely to persist. Sure enough, the slide continued for the rest of the week. If you look at a chart of these stock prices, then you can see how technical analysis has appeal. The problem is that we have the benefit of hindsight. It's a lot easier to find a pattern after the fact. Now, I have a confession to make. Remember those first two stocks I described? They weren't real. I just used a random number generator to produce fake prices. But they sure seemed real, don't they? As eerie as it seems, random number generators produce patterns that look incredibly like actual stock returns. The reason that the path of stock prices look a lot like a random series is that prices from a competitive market with low transactions costs should look a lot like a random series. If a pattern really did exist, like price increases tend to be reversed, then clever traders would sell as soon as the price moved up. That would tend to keep the price from moving up in the first place. The result is an unpredictable series of stock prices. Now, I am not saying that stock prices are perfectly random. There's some evidence that stock prices tend to overshoot the right value, and there's some evidence that they take too long to react to news. But the evidence is sometimes contradictory and far from conclusive. People like us are better off leaving these potential profit opportunities, and I emphasize the word potential, to the experts who have the information sources, the huge investments in trading systems, and the time to chase them. If stock prices do deviate from the fair price, it's usually just a few cents per share anyway. When I'm deciding whether to buy or sell a stock, I always start by assuming the price is fair. I assume that it isn't overvalued and it isn't undervalued. I behave as if the price is fair. Notice that I didn't say that the price is correct. In fact, we're almost sure that within a matter of days or even hours or minutes, the price will prove to have been wrong. How can the price be wrong but fair? The answer is that stocks are risky. We don't know what the price will be tomorrow. Think of flipping a coin. There's a 50-50 chance of heads and a 50-50 chance of tails. If the rules of the game say that I give you $1 every time it lands heads, then how much do you have to pay me to make the game fair? The answer is 50 cents for each flip. Half of the time you'll win $1 from me for a profit of 50 cents, and half of the time you'll lose your investment of 50 cents. In the long run, we're both probably going to be even. That's fair. But unless the coin lands on its edge, we'll never be even on any one flip. Either you win 50 cents, or else I win 50 cents. For each individual flip, the price is guaranteed to be wrong every single time. But the game is still fair. You should think of a stock price the same way you think of that coin flip. The price is wrong, but it's fair. Some days the stock price might be too high. Some days it might be too low. It's almost never exactly right. For example, on October 15th, 2002, IBM closed at $68.48. The next day, on October 16th, it closed at $64.90 for a loss of over 5.2%. That doesn't sound like the price on October 15th was right, does it? You would have lost over 5% of your money in one day. No, it seems to me that the price the day before was too high. 8 years later, on October 15th, 2010, IBM closed at $141.06. And the next day, it closed at $142.83 for a one-day gain of 1.25%. With hindsight, IBM was quite a bit overpriced on October 15th, 2002, and underpriced by a moderate amount on the same day in 2010. Day-to-day price changes are the rule, not the exception. In fact, IBM's share price was the same for 2 days running, only 9 times from 2003 through